My name is Brandon Hines, and again, I'll be moderating today's session for leverage in the excess value of diversified firms. At this time, I will transition everything over to Dr. Ibe Ibekwe.
Thanks, Brandon, and welcome everybody, and thanks for the opportunity to present the work I've been doing. Actually, I defended my dissertation last year, and this is one of the papers we are working on crafting from the research I did. The research I did was on insider ownership and the performance effects of diversification in Nigeria. So we're developing this paper to see if we can publish it. So what I'm going to present is just that this paper. I'm grateful to Dr. Tippins, who was my chair, and Dr. Mohammed, who was the committee member, and Dr. Hausman, who was the university reviewer. So if anybody's interested in my dissertation, from which I crafted this paper, you can look at it from, it's published in ScholarWorks, and you can look it up from the university library. Can we go to the next slide? Okay, so let me clarify some concepts so that I can carry everybody along. Diversification is a strategy, a corporate strategy in which whereby companies operate in more than one industry. Okay, so we use the standard industrial classification code to classify companies. So if a company is operating in more than one industry, we classify it as a diversified company. Otherwise, it will be a focused company or a non-diversified company. So the fact is that diversified companies feature prominently in many countries in the world. In Germany, for instance, they are about 60% of all companies employing up to 20 people or more. In emerging markets, they are very prominent. In India, for instance, they constitute about 95% of companies operating in India. In China, about 90% in other emerging markets. In Nigeria, in the study I did for my dissertation, they constituted about 63% of the farm years that we looked at, okay? But the issue is that the performance effects of diversification is a topical issue in the area of finance and in the area of corporate strategy. There is no consensus at the moment as to how diversification affects companies, okay, the performance of companies. But one dominant strand of the literature is that diversified companies perform below focused firms, focused companies, or undiversified companies. That's what we call the diversification discount literature, strand of the literature, which says that diversified companies underperform focused companies. But what evidence we have is that there are some other companies, diversified companies, that also outperform focused companies. So the question becomes, what factor can we identify that will distinguish diversified companies that create value, that perform better than focused companies, and those that underperform, okay? So in my dissertation, I tried to look at insider ownership, what we call insider ownership, as one of those factors. But that factor was not a significant, it had no significant relationship with the performance of companies. So that led me to start looking at other factors, and I came across a paper by Lee and Lee in 1996. And they argued that why some diversified companies underperform focused companies is that they do not make use of the potential that diversification creates, the borrowing capacity that diversification creates. In other words, if any diversified company is able to make use of the leverage, the debt capacity that diversification affords, it's likely to perform better than focused firms and perform better than an average diversified companies. So nobody has tested this theory or this hypothesis by Lee and Lee especially in the emerging market context. Okay, the only study that is close to it, to the best of my knowledge, is that published by Roland and Zhu in 2005, and Marcia and Reed in 2002. Okay, and these are studies that were conducted in the United States. So, as you all know, the context of the United States is quite different from that of emerging markets, and we do not expect most of the things that are obtained in the United States to obtain in the emerging markets, especially in Africa. Nigeria is one of the major economy in Africa. So that's the problem. We don't know how leverage is related to the performance, the valuation of diversified companies in emerging markets, especially in Nigeria. So the purpose of this study was to examine the relationship. This is a quantitative study, was to examine the relationship between leverage, and by leverage we mean the extent to which the company uses debt, in its capital structure. The relationship between the value of diversified firms and what we call the excess value of diversified firms. So the dependent variable here was the value and excess value of diversified firms. And the independent variable was leverage, which we measured by total leverage, by short-term leverage, and by long-term leverage. By total leverage, we mean the total debt to assets of the company. And by short-term leverage, we mean the short-term liability of total assets. And by long-term leverage, we mean the long-term liabilities of total assets of the company. We measured the dependent variable, which is firm value, by the Tobin skew, and the excess value by a construct I developed during my research, during my dissertation, which we call excess value, approximate excess value. So what is the significance of this research? The significance from the literature perspective, from its significance to literature. I'll talk about this significance for social change and practice later on. But for the literature, what we are bringing in is we are examining the relationship between leverage and value of diversified firm and the excess value of diversified firms in an emerging market context. Nobody, to the best of my knowledge, has done this. The two studies that I said are very close to what I did in this study is Roland and Zhu, 2005, and Mency and Reed, 2002, which were published, which were studies conducted in the American, in the US context, okay? And to the best of my knowledge, nobody has done this kind of study in Nigeria. And I used an analytical technique we call the multi-level generalized method of moments. To the best of my knowledge, again, this analytical technique has never been used in the diversification literature. Okay, the advantage of this technique is that it enables us to control for endogeneity. Endogeneity is things like reverse causality and other endogeneity concerns. There are traditional methods that have been used, like the LOS, two-stage least squares regression, and the systems generalized method of moments. But the problem with this is that usually you don't find the reliable instrumental variables, and there are usually no natural experiments that we can use as instruments, okay? So this technique kind of uses the hierarchical structure of multi-level data sets to develop what, if you may like, internal control instrumental variables. So where you are not able to have valid instruments, which is usually the case in making causal inferences, this technique comes handy. And like I said, I'm not aware of anybody who has used it in the diversification literature. For the theory that we used, the two theories form the basis of this study. The theory by Lee and Lee, 1996, what they call the corporate scope and financial theory of corporate scope and financial structure. This theory is basically suggesting that diversified firms create, or diversification increases the debt capacity of firms. Okay, So when the debt capacity of firms increase, firms can benefit by having access to capital to fund positive net present value projects, okay? And most firms, especially in emerging markets where access to funds is limited, you know, this is a huge advantage which can increase the performance of companies and the valuation of these companies. The second theory we used was the Jensen theory of agency cost theory, especially as it relates to the free cash flow. Okay, the argument of Jensen in this in his paper is that leverage or debt holders kind of add an additional layer of corporate governance by monitoring managers in their use of resources, corporate resources. Okay, so this theory also will suggest that if diversified companies can use leverage, it will improve corporate governance, it will improve monitoring of managers, and definitely will reduce agency costs, which will translate to higher valuation in the capital market. So these are the two theories that form the basis of this study. Brendan, can you go to the next slide, please? Okay, so there are a lot of literature. The literature on diversification is a very old one. It's huge since in the 1950s, you know, but I did a significant review of this literature during my research. What we can say is that diversification features prominently like I mentioned, all over the world, diversified firms contribute significantly in terms of employment, in terms of output, in terms of total sales of companies all over the world. And the speculation or the projection is that they are going to continue. The diversified firms are not going to cease. You know, they will continue even as economies develop. You know, diversified companies keep increasing in their activity. You know, so it's going to remain significant contributor to the economy of many countries in the foreseeable future. But the performance, the diversification performance literature there is no consensus. While the dominant version of this literature says that diversification leads to what we call diversification discount, there are a good number of studies also that have said that diversification can contribute to increased firm value in some contexts, especially in emerging market context. Okay, there is no consensus, but what is standing is what we know is that there are some diversified firms that outperform focused firms, and there are some diversified firms that underperform. So Lee and Lee proposed that why some diversified firms underperform focused firms is because they do not make extensive use of the borrowing capacity, the debt capacity that diversification creates. Okay, but there is I'm only aware of Ruland and Zhu that have tested this hypothesis, you know. And why Ruland and Zhu support Lee and Lee, Mansi and Reed do not. Mansi and Reed found that, or they concluded that the diversification discount is more pronounced in companies that have an above average leverage, okay? Which is inconsistent with what Lee and Lee are proposing and what Ruland and Zhu also found. Okay, that's a summary of the literature as it relates to the relationship between diversification and leverage and the performance or the valuation of diversified companies. Okay, many studies have used leverage as a control variable, but as Duan and Lee, 2006, pointed out, it is not enough to include leverage as a control variable. Okay, so that is why we decided to test whether there is any significant relationship between leverage and the performance and the evaluation of diversified companies. Next slide, please. Okay, we addressed two main research questions. First and foremost, how is leverage related to the value of diversified firms? Okay. The second question we address is how is leverage related to the excess value of diversified firms? By value of diversified firm, we mean the Tobin's Q, which we calculated as the market value of the shares, the equity of the company, plus its debt divided by the total assets of the company. That's an approximation of the Tobin's Q. And the excess value we measured by the difference between the average value of focused firms in any particular year and the value of every diversified firm. That's what we mean by excess value. So the procedure we used was we classified all non-financial companies that are listed on the Nigerian Stock Exchange from 2008 to 2018. We classified them using the United Nations Standard Industrial Classification Code, SIC codes, into diversified companies and focus companies. If a company operates in more than one two-digit industry code, we classified it as a diversified company. Otherwise, it is classified as a focus company. Okay, and we measured leverage, total leverage, by the debt, total liabilities to asset ratio, and we decomposed leverage into what we call long-term leverage and short-term leverage. Short-term leverage, those leverages that are maturing within 1 year, and I mean the debt over total assets, short-term debt over total assets, and long-term debt over total assets. That's our measure of short-term leverage and long-term leverage. Then we followed my research again, 2021, which we published this, my dissertation. We used the same measures of SS value, which we called SATK average and SATK serve. We followed the CO 2010 to calculate SS value as a difference between the focus, the value of diversified firm of a particular diversified firm and the average of all diversified all focus firms in the economy, in the data set. Okay, the total number of participants or companies that we used was 62 non-financial service diversified companies that are listed on the stock exchange between 2008 and 2018, which is a total period of 11 years, and it gave us a total of 682 farm-year observations. As I said, we analyzed the data. I analyzed the data using the multi-level generalized method of moments technique to test our hypothesis, two hypotheses we stated here. As I mentioned, it has an advantage because it's able to control all the endogeneity concerns that we may have. For instance, there has to be, or there is always a reverse causality. You know, people can say that lenders lend to companies because their values are high. In other words, it is not leverage that is driving performance, or leverage that is driving value, but value driving leverage. So we have to control that endogeneity we call the reverse causality. So for me, given the unreliability of some of the instrumental variables out there, and again, I use the systems GMM to test this hypothesis, but the Hansen test showed that the instruments were not valid. So this method was a way of overcoming that, okay? So that's what we did in this study. And we did some robustness check. For instance, we leveraged balanced focus firms and diversified firms to see if there is any difference between those diversified firms that are performing very well in terms of their valuation and the focus firms that are also performing very well. That's the robustness check we did. The next slide, please. So these are our findings. Our findings are consistent with what the theory suggests. We found a very significant at the 1% level that leverage is significantly and positively related to the value of diversified firms. Okay, in all the measures of leverage that we use, in the total leverage measure of leverage, in the short-term leverage, in total long-term leverage, we found that leverage was significantly and positively related to the value of diversified firms. We also found that, I also found in this study that all the measures of leverage were also positively and significantly related, some at the 1% level, which is quite significant, with all the measures of SS value that we use, the two measures of SS value that are used in this study. So that, and given the fact that we used the multiple level generalized method of moments, this is not just a relationship, but we can make some causal inferences, okay, because we control reverse causality and all the endogeneity problem that omitted variables and all the rest of them. So this is highly significant, okay? So can you go to the next slide, please? Okay, so the interpretation of this study, like I said in the beginning, Lee made the proposal that why some diversified companies underperform focus firms is because they do not make use of the capacity, the borrowing capacity that diversification affords them. So if therefore the expectation will be that highly leveraged firms will be valued more than less leveraged firms. And our finding is consistent with that proposition, okay? And our study is consistent with the findings, is consistent with Lee and Lee 1996, is consistent with Roland and Zhu 2005. And it is consistent with the idea that what we call the more money effect and corporate governance role of leverage. Leverage is argued to play two roles. First and foremost, it increases the capacity of companies to fund positive NPV projects, which will increase their performance and ultimately their valuation in the market. And it also, as a layer, another layer of corporate governance. It monitors the debt holders, monitor the managers, and that helps to improve performance. Unfortunately, this study is inconsistent with the Mansi and Reeve, which is a very popular literature, a very popular study in the diversification literature, because they argued or they found evidence that is consistent with their conclusion that the diversification discount is only pronounced in companies that have above average leverage levels, which is what we are arguing against. What our own finding is contrary. Our own findings is that diversified companies that have above average leverage tend to do better in terms of their valuation than those ones that are not highly levered. So one limitation of this study is that my measure of diversification. I used one measure of diversification. My measure of diversification is the number of industries measured by the number of zip codes in which the company is operating, okay? There are some proponents, there are some people who argue that diversification should capture not only the number of industries that companies operate in, but also the contribution of each industry to the overall performance, overall output of the company. I was not able to, extend my measure to that because of limitations in segment reporting. The Nigerian companies are coming into segment reporting in Nigeria is not yet well developed. So most of the segment reports they give are not quite reliable, and they are not comparable from one company to another. So my best bet was just to use one of the measures that have been used over time, which gives a comparative. You can compare diversification from one company to another. So that's one limitation. And as we go ahead and as segment reporting keeps improving, we might have sufficient data to be able to measure diversification along those lines of how much a particular industry is contributing to the overall output of a company. Okay, so that's, for me, that's the main limitation of this study. And going forward, probably as we get better data, we can improve this measure. So what I'm recommending, especially for future research, is to deal with this measure of diversification, which we are intending in a couple of years. As we get better data, we can do that. Okay, and I'm from strategy point of view, I am proposing or I'm recommending that diversified firms should increase their leverage, because diversification, one advantage that diversification gives to companies is that it kind of gives them a more stable cash flow, okay? And the more stable cash flow is what attracts lenders, okay? So if a company has that advantage, which is a competitive advantage, and is not able to exploit it by borrowing more, okay, to be able to fund, positive NPV project, then it is not exhausting, it is not exploiting its potential to the fullest. And that might be the one reason the diversified companies, some diversified companies trade at a discount, okay? And leverage also, adds to corporate governance. It's a layer of corporate governance. Many people have suggested that it is a good corporate governance mechanism, like Jensen and many other proponents of the agency theory, okay? They recommend leverage as a way of reducing the free cash flow that is at the discretion of managers to spend. The argument is that when managers have a lot of resources and there is no control over these resources, they tend to mismanage it, okay? So I'm recommending that diversified firms should exploit fully their potential by increasing their leverage. The social implication of this study, of these findings, is that we know that companies, businesses contribute to the society. They create the products and services that they create employment that the society depends on. Okay, so the survival is the game. Survival is the name of the game. Every company is striving to survive, and we know that the survival rate of companies has been on the decrease. And consistent performance has also been on the decrease. So one of the strategies that companies use to sustain themselves and improve their performance is diversification. But as they diversified, the studies have shown that it's not a value-creating strategy. So one way that we can improve that and make companies more sustainable, especially diversified companies that feature prominently in most economies, is to increase their leverage. By increasing their leverage, they're able to attract more resources. They're able to increase their valuation and attract more resources to sustain them, and so that they can continue providing creating those innovative products and services that the society has come to depend on. And from an investment perspective, many people invest in the stock markets. My recommendation or the social impact here is that investors can benefit more if they want to invest in diversified firms, they can benefit more by investing in those diversified firms that have above average leverage levels than those that have less leverage, okay? The reason is that diversified firms are prone to agency problems. So one way that they can curtail agency problems is by leverage, by borrowing, by debt, contracting debt. The debt holders will kind of add a layer of corporate governance, a layer of monitoring. Okay, so those are the two social change implications that I identified in this research. The next slide, please. Okay, so we have a couple of references. Like I said, they're quite an old, but we tried to focus on the major ones, recent publications on the diversification performance and diversification valuation relationship, which I have, I think I explored that extensively during my dissertation process. Thank you so much, and I'll be glad to take your questions. Thank you for coming and participating.
Thank you, Dr. Ibe. Thank you for sharing your presentation and your expertise with us. Just like you said, at this time, we invite any participants. Feel free to ask any questions if you want to come off mute or type them in the chat. All right, I don't see anything at the moment. Dr. Ibe, is there any closing remarks you want to say before we wrap up this evening?
My closing remarks would be like I encourage those who are still in the process of finishing their dissertation, just don't throw in the towel. Sometimes it could be difficult, but Walden makes a lot of things easy for us. I find it quite easy, the whole process. Perseverance is the game. You always, if you think there's any way we can work together in related areas on issues of corporate strategy, finance, my specialization, then that would be great. I'll be available to work with anybody. I think there's a question. When you perform multi-level regression, did you make a decision regarding centering of level 1 or level 2 predictors? If so, did you see any difference of the interpretation of regression parameters? Actually, we did not. We of course we centered. I adopted a group centering, and all the robustness checks that I did, like I said, we couldn't change our interpretation. So the relationship remains very robust, irrespective of all the checks that we did. That's Charlie.
All right. Well, it looks like that may be all the questions that we have. Again, Dr. Ibe, thank you again for your presentation, and for everyone who joined us today. Thank you for your time here.